What is going on, you guys? Welcome back to the channel. So in this video today, we're going to be talking about a step-by-step plan for going from scratch or like $0 as a complete beginner, somebody just getting started with their finances, to a financial plan for building up a net worth of around $350,000 by age 30. And just for a bit of background here, guys, I actually was planning on following this exact plan when I was younger, and I followed it for many years going forward from 18 to about 21, but I ended up starting a YouTube channel which ended up being much more successful than the previous path I was following. However, this is the exact step-by-step plan I was planning on following back when I was just 18 years old, and I want to tell you guys that this is not something that you're going to see anywhere else. I literally, on a plane ride the other day, wrote it out on paper myself. So this is not some kind of Dave Ramsey plan or anything you're going to see anywhere else. But what it is a step-by-step plan for setting yourself up for success financially. Because when I was in my 20s, my whole mindset was, how can I set myself up for an easy life for the rest of my life? What things can I do in my 20s to set myself up in my 30s, 40s, and 50s? Because what many people don't realize is that what you do in your late teens and in your 20s is what's going to set you up for the rest of your life. And you'll be much better off by having a solid financial plan where you're owning many different assets and setting yourself up for a good life financially. Now, that being said, guys, I do have to make a quick disclaimer here that I am not a financial advisor. This is not financial advice. And while these strategies have worked for me and other people, there's always unforeseen risks out there. And before you make any of your own investments, you should always do your own due diligence. That being said, guys, one quick thing here I have to ask you. If you are watching this on your desktop and you have a phone next to you, make sure you silence that phone and get rid of any distractions, because I'm going to be teaching you a step-by-step plan for setting yourself up for success financially. And if you get distracted, you're going to basically lose track of what's going on and probably not take action on this video. So do yourself a favor, put that phone on silence unless you're using it to watch this video. Take out a pad of paper and a pen for some notes, and let's get right into it. Alrighty, guys, so step one of this plan actually starts before the age of 18, and this starts when you are just 16 years old. And step one of this plan is making sure you maintain a good relationship with your family. And what I mean by that is, a lot of my friends in their late teenage years had a lot of arguments with their parents, and they ended up in this situation where they were moving out of the house by age 18 or 19 or 20. And while there's nothing wrong with growing up and moving out of the house, it's a lot harder to do that in 2021 than it was to do many years ago. So what I want to encourage you to do, if you're 16 or 17 and you're still living at home, you want to make sure you're maintaining a good relationship with your family, because that's what's ultimately going to allow you to live with them in a civil environment for as long as possible. So when I was 16 years old, I made sure that I was helping out around the house, I was doing chores, I was working a part-time job, and earning my own income. That way I wasn't a burden on my family. And I want to encourage you guys to do the exact same thing. So step number one on this plan at age 16, maintain a good relationship with family members. And the other thing I want you to do at this age is to speak to your parents and speak to your grandparents and ask them whether or not you're going to have any money to help out with your first car or with college. So full transparency here, guys, when I was 16 years old, my grandfather helped me out with $5,000 towards my first vehicle, and he also helped me out with about $10,000 towards my community college education. And so some families are going to be able to offer this based on their finances, while others may not be able to. And it's important to understand that whether or not your family helps you with this, you're still going to be able to do well and figure out a good plan. However, the very first thing you have to understand is whether or not anyone plans to help you with paying for a car or paying for college. If the answer is yes, you're in luck for sure. And if the answer is no, we're just going to have to figure out a plan for paying for a car and potentially some level of college education. So step number 1, at age 16, remain civil with your parents as long as possible, help out around the house, and ask questions about your first car and your college education. Alrighty guys, so step number 2 on this plan happens when you turn 18 years old. And I'm kind of a finance nerd myself, I always have been, so I actually decided to do this on my 18th birthday at about 9:45 in the morning, and that is opening up my very first credit card. Now, most people are not thinking about this at age 18, and it's not something you really think about until you're usually in your mid or late 20s. But the important thing is here, you have to establish credit early in order to begin building up something called your credit score. And if you're not familiar with what this is, guys, a credit score is kind of like a report card for adults. So, as I'm sure you know, in school, you're getting your report card every single quarter or however so often that it comes, and that is a report for how you're doing in school across your different programs. Well, your credit score is pretty much the exact same thing, and every time you make good decisions with your money and your credit, it tends to go up, and if you make bad decisions like overloading your cars or skipping payments, well, your credit score or your report card goes down. However, the longer that you have credit available to you, the more this score goes up over time, so it's important to establish good credit card habits early. So essentially, what I did to get my very first credit card on my 18th birthday is I went into my bank and I opened up what is called a secured credit card. And essentially what this means is you're setting a set amount of money aside to actually back that credit card with something called a certificate of deposit. Now, that's pretty confusing, guys, and kind of deep in the weeds, but essentially you're putting up some collateral in case you don't pay your credit card, and if you don't, they can just simply take that money and pay off the card. So with a secured credit card, the risk for the bank is zero because you're putting up the collateral in case you don't pay your bill. So what you want to do is on your 18th birthday or shortly thereafter, go to your favorite bank or credit union and inquire about opening up a secured credit card. I started off with a balance of just $500, meaning I set aside $500 in a CD to back that credit card. And then what I would do is every single week, I would put my gas on that credit card and then pay it off every single month in full. And while it may not sound, very important to be putting a couple $100s on your card per month and paying it off, well, every single month, a on-time payment is being reported to the credit bureau, as well as you paying off that entire balance. And what this begins to show is that you are a responsible borrower who has, good financial sense in terms of knowing what to do with their credit card and making sure you're making payments. Now, after you get that secured credit card, you're going to want to wait anywhere from 6 to 8 months while you slowly build your credit and make those on-time payments. And then after that, the very next thing that I personally recommend is applying for a store credit card. Now, your store credit cards are very easy to get because most retailers don't have very strict requirements in terms of who they offer these cards to. In fact, you're actually looking at one of the former store credit card experts here. I used to work for JCPenney, and I used to help people sign up for these credit cards to get a discount on clothing. So I used to get $2 in my paycheck every time somebody signed up for a JCPenney credit card, and so I was always promoting these to people. Now, later on in life, I learned about how store cards can be very dangerous, and they're definitely not something I recommend to shopaholics, but if you can be responsible with your use of credit cards, then a store card is a logical next step. Now, in my case, I ended up getting a JCPenney credit card from my employer, and I used it for my Christmas shopping and to take advantage of different sales, and that's exactly how I recommend using it. Use your secured credit card to buy gas, pay it off in full every single month. and then put small purchases on a store credit card and pay that off every single month. The whole point here, guys, is to pay $0, nothing in interest. That way, you're building credit and essentially getting a free loan from these credit card companies without actually paying any interest. If you find yourself paying interest or racking up a credit card balance, you may not be somebody who should use credit cards, and so it might be a good sign that this just isn't for you. But if you're able to do it responsibly, this is one of the best assets that you have going for you, is building up a good credit score in your early 20s. And after that, guys, after you have that secured credit card and your store credit card, the next logical step is to go out and get a student credit card. These are credit cards designed for college students, and in my case, I ended up applying for a Discover student credit card in my first or second year of college. Now, at that point, I had already had my secured credit card for somewhere around 3 or 4 years. I had my JCPenney store card for around 2 years, and so over that period of time, I had built up a credit score that was now around 700. And so when I applied for that student credit card with Discover, they had absolutely no problem accepting me because of my good credit score. Now, to share a different story with you guys, a friend of mine never did the secured credit card, never did the store card, and at age 22 basically had zero credit, and he tried applying for a Discover credit card, and even though it was for a student card and he was a student, they still turned him down because he had no prior credit established. That is why the secured credit card and then the store credit card is so important to this formula. So now that you understand the importance of establishing credit young, and that's really going to help us out in a couple of years going forward, another step to follow when you're 18 is potentially getting a community college education. Now, speaking from personal experience, like I said, I had $10,000 put aside towards my college education, which I was very fortunate to have because my grandfather had set aside some money for the grandkids. Again, I understand that not everybody has this available to them, and so some people have an unfair advantage here. So if you have money from any person in the world other than like the federal government giving you a loan towards college or towards your first car, understand that you truly have won the lottery here, and most people just do not have that option available to them, so don't waste it. That being said, if you are looking into college, what I would recommend is looking for a high ROI program or high return on investment. Now, myself personally, I ended up going to community college for electrical construction and maintenance, which was a 2-year associate's program. What that means is that after 2 years, I would be able to get a job without having to continue on and get a bachelor's degree. So I ended up getting this degree over a 2-year period. I got my associates in electrical construction and maintenance, and I ended up working for my local power utility where I earned a really good salary, but we're going to get into more of that later. The important thing is at 18 years old or 17 when you're graduating high school and figuring out your next step, if you don't know what your passion is in life, which was me, and you have no idea what interests you, look at a high ROI program from community college. A few to recommend to you guys would be nursing, dental hygienists, x-ray technicians, and anything related to trades. Those are all good bets in terms of high ROI programs. So that's the next step here, guys, is figure out if college is something on your path. And if so, look for a high ROI program at a local community college. Now, you have just one more step at age 18 for this plan, and it is to figure out your first vehicle. Now, I'm actually doing a video shortly on the best cars for $5,000 or less, and by the time you're watching this video, that video is already on my channel. So make sure you pause that and check that video out later if you want some help on that. But the next step here is to figure out purchasing a used car for around $5,000. Now, as I said earlier, my grandfather did help us out with our first cars, and he gave me $5,000 towards the purchase of my first vehicle, which I was very thankful for because this allowed me to buy a car that wasn't a complete piece of junk. If you're spending like $1,000 on a car or anything around there, you're pretty much getting a heap of junk in most cases. These days, it's pretty hard to find a good used vehicle for, any less than $5,000 that's not going to be an absolute money pit and something that needs numerous different repairs. That being said, guys, I'm going to give you a few general pointers here. Hondas and Toyotas tend to be some of the best vehicles out there. You want to avoid domestic vehicles like Dodge, Ford. They go down in value a lot faster, and they don't tend to be as reliable. So something like a Toyota Camry, Toyota Corolla, Honda Accord, Honda Civic, Honda CR-V, anything in that realm is probably going to be your best bet for a $5,000 car. And essentially, guys, you want to have this goal of purchasing your first car with cash because it's really going to be difficult to get attractive financing at 18 years old getting your first car. And another question I want to address here is whether or not you should get your first car at age 16 or age 18. And speaking from my experience, I got my first car when I was 16, and it ended up being a big money pit in terms of insurance and gas, and I didn't find I actually used the car that much. So I actually recommend holding off on purchasing your first car until you are either 17 or 18 years old. However, that doesn't mean don't get your license. You should still get that at 18, just so you're ready for the next step in life. But that's the final chapter here, guys, in age 18 is to go out there and purchase a car for around $5,000 that's not going to break the bank. It's going to be somewhat reliable, hopefully. And your goal is to own a vehicle and have $0 in debt in terms of any form of car payment. Down the road, you're going to replace that car and you're going to get a car loan. But for now, just try to own something free and clear that is a reliable form of transportation. And if you don't need a car whatsoever, maybe you hold off on the vehicle until you get your first job. So now, from age 18 to age 21, it's a pretty simple process. What you're going to do is continue paying the full balance on your secured credit card, your store credit card, as well as your student credit card. If you choose to open up more credit cards in this time, just do so responsibly and understand that every time you open up a credit card, it may lower your credit score. So I would just recommend keeping track of that score as you go. Not to mention, if you did have to, get any kind of loan for a car, hopefully you don't have to, but if you did, aim to pay it off from age 18 to 21. Essentially, you want to exit college ideally with no college debt, no auto debt, and no consumer debt. I know for some people this is difficult, but I'm telling you guys, it's not impossible if you really work hard and minimize those expenses. Like I said, some people, including me, did have the advantage of having some family money for the community college and the first car. However, even if you don't have that, if you work during college and save up your money, I'm a firm believer that as long as you're living at home and you maintain that relationship, that good relationship with your family, which was step one, you should be able to live at home for cheap, if not free, save your money, put it towards college, put it towards that vehicle, get everything paid off. Ideally, age 21, you find yourself exiting college with a high ROI degree, with a good credit score, with no debt, period. So it's a lofty goal, but trust me, guys, it's something that you can attain if you work hard. Now, this is where things start to get more exciting because you're able to begin building your net worth. Now, somewhere around age 20 or age 21 is when you're going to be finished up with community college and looking for a job. And that's all going to depend on what your degree is in terms of what type of employment options are available to you. So what I do want to say about this, guys, is I always liked looking for jobs that included some amount of downtime. Because just to fill you guys in, so far everything we've discussed is exactly the step-by-step plan that I was following before I started this YouTube channel back in 2016. Now, I graduated from community college back in 2015, and I got a job in 2015, so it took me a little while there before I started this channel, but from 2015 to 2016 is when I was just kind of working this job and saving my money. But essentially, that's where I veered off to the right, and this is where this path continues straight. I ended up deciding to invest my time into this YouTube channel. I quit that job to accelerate my income. But even if I didn't, even if I kept following this plan, I truly believe I was on track for a very good start. And so this is where the plan starts to deviate away from what I actually followed. So at age 21, you want to find a job, ideally with some downtime, because that downtime on my job is what allowed me to create my YouTube channel. I had about 4 hours of work per day, and for the other 4 hours, it was pretty much just keep yourself busy and don't bother anybody. So I would get all my work done in the morning, and I would spend the afternoon outlining my YouTube videos quietly and just minding my own business. So that might be a good option if you're looking to start your own side hustle like a YouTube channel. So once you lock down that job, hopefully a high-paying one from your high ROI degree, at this point, you're pretty well off because ideally you have no consumer debt, no auto loan debt, your crappy car is paid off, and so at age 21, this is when I would invite you to replace that original vehicle. Now, if you bought a somewhat reliable car for around $5,000 in 2018, and you bought like a Honda or a Toyota and you made a good pick, maybe that vehicle is still good and you could still drive it. So if you don't necessarily want a newer car and that vehicle still works, I would encourage you to just keep that as long as possible. But if you're finding that that $5,000 car that you bought 3 years ago is turning into a money pit, or it's rusting out, or you just simply want to drive something a little bit newer, this is when you can purchase a 2 to 3 year old certified pre-owned vehicle, which is exactly what I did myself. So at my first job, I was driving my old beat-up car, which was a 1999 Honda CR-V. And fun fact, guys, I still own this vehicle. I've had this car in my family for like 10 years now, and it still runs pretty good today. But at the time, I was driving this old beat-up Honda, and then at age 21, I decided to buy a newer car just because I had a really long commute. I had no debt. I had a good amount of money saved up, and I was tired of driving around a car with busted air conditioning and not a great sound system. So I ended up buying a Chevy Cruze, which probably looking back wasn't my best choice because it's a domestic vehicle. I should have bought a Honda or a Toyota. But anyway, I bought a 2 to 3 year old certified pre-owned Chevy Cruze, and because of all the steps I had followed earlier on, I was actually able to buy this vehicle, get good financing without having to actually get a cosigner. Now, for those of you that know me and have watched my other videos, you will know that I had a couple of financial mistakes in this period where I had a couple of different cars when I was younger. At one point, I had 2 cars, and I was driving a Subaru WRX that I bought on impulse that I actually lost like $9,000 on. So I'm not saying that I've done everything perfect here, guys. In fact, I did make a lot of mistakes when I was younger related to buying vehicles, and they were really good lessons for me. But nonetheless, that Honda has always been the most reliable vehicle I own, and at age 21, I replaced that with my pre-owned certified Chevy, and I did that through a loan. Again, because of my good credit, I was able to get attractive financing, and I had an interest rate of somewhere around 5%, which is pretty good for a 21-year-old without a cosigner. Now, the important thing to remember here when purchasing that vehicle, if you do decide that you need a newer car, number one, never buy a new car. That is one of the dumbest things you can do, and you're going to take a huge loss in terms of depreciation. That's why I say 2 to 3 years old, let someone else take the hit on depreciation, and you get yourself a gently used certified pre-owned vehicle. Another thing, aim to put 20% down on that vehicle if possible. If you're able to continue driving that old car from college or high school and save up a bunch of money, try to put 20% down on that vehicle to avoid something called gap insurance. Gap insurance is essentially something that you should have if you are driving like a brand new vehicle. And what that means is if you total that car and the insurance company doesn't pay you as much as you owe on the car, the gap insurance would cover the rest for you. That way you're not stuck owing more money than the car is actually worth. But if you do have 20% down or more on that vehicle and it's 2 to 3 years old, especially if it's a Honda or Toyota, you shouldn't have any worries about gap insurance and you don't have to waste money on this. Also, guys, another thing I recommend at age 21, if you haven't been doing so already, once you get that first job or shortly thereafter, begin contributing towards rent at home. So a lot of people may not want to live with their parents at age 21, but if you're looking to do what makes sense financially, that is oftentimes your smartest move. And so that's why I said at the very beginning, at age 16, you got to maintain a good relationship with your family or your guardian, whoever it is, because you want to stay there as long as possible. These are always going to be your cheapest years where you're able to save the most money. And so at age 21, hopefully you're still able to reside at home. And this is when you are going to offer to pay rent towards your parents or whoever you live with. Now, myself personally, I was paying my mother $600 per month towards the mortgage since I was a working 21-year-old adult still living at home. And so I wasn't a freeloader. I was making good money, and so I helped my mother out in the process, and I encourage you guys to do the same thing. And if your parents flat out say, no, we're not taking rent, well, then you are blessed, and you have a really good situation to save and invest a ton of money that other people just don't have available to them. So from age 21 to age 24, you want to have the goal of saving as much money as possible, and you're going to keep doing everything you've been doing. You're going to make your credit card payments on time. You're going to keep putting gas on your credit card and paying it off. You're going to pay off credit cards every single month, pay $0 in interest. You have ideally, no debt, no consumer debt. You might have a small car loan where you have a reasonable interest rate since you've already built your credit. So now from age 21 to age 24, my challenge for you is saving 50% of the income from your job. And I know what you're saying, Ryan, that sounds crazy. That sounds impossible. How am I going to do this? But guys, this is what I did myself. I was working. I was living at home. I was driving the old car. Even when I was driving my Chevy, I was still able to save about half of all of my money. And let me tell you how I was able to do that. So the very first thing I did that allowed me to save 50% of my income was bringing my lunch and bringing coffee to work every single day. I know this doesn't sound like a lot of money, guys, but I did the math one day and I realized that if I were to buy a coffee on the way to work and then go out for a lunch and pick up a snack for later, it was going to cost me $20 per day. Now, I worked that job 5 days per week, which means every single week I'd be spending $100 per week on coffee and lunch and a snack. Obviously, guys, per month, that's $400 per month. And over the course of 1 year, that's around $5,000. So I could not justify that expense personally. So what I decided to do is make my own coffee at my desk. I actually bought one of those 4-cup coffee makers, made my coffee every single morning for like 10 cents a cup. And then I made my own lunches at home on Sundays and brought those into work for the week. This may not be fun, guys, trust me, especially if you work a desk job. It's nice to be able to get out of the office and go get lunch, but I would instead encourage you to eat your food and drink your coffee at your desk and then simply go take a walk during lunch to get that same outing and get some sunshine. But literally, guys, just by making your own food at home from age 21 to age 24 and coffee, just between those two things, I'm convinced that could allow you to save about $10,000 towards your first big investment, which we're going to get to soon. Another thing you should be doing while working this job is contributing to the 401k, which is your employer-sponsored retirement savings plan. The other thing that you should be aware of is that oftentimes the 401k is able to be used towards the down payment of your first home. So you might be worried about locking your money up forever in a retirement account, but there are some scenarios that allow you to use this money early, one of which is the purchase of your first home. Now, a lot of employers offer something called an employer match, which is where your employer is matching your contributions towards your 401k. So in my case, with my job at the utility company, they would match me 50%, dollar for dollar, up to 6%. So what I did is I put 6% of my pay into my 401k, and they gave me an additional 3% for free. Free money, literally just put it right in my 401k, a free bonus that a lot of people just don't take advantage of. So for those years that I worked for this company, every single week, 9% of my pre-tax income was going right into my Vanguard 401k. I wasn't touching it, I didn't see it, I didn't even know it was happening, but I was automatically saving and investing every single week. Now, if your employer does not offer any kind of 401k match, probably not something that you have to do, but I would still set aside that same money in your savings account or some type of separate investment account if you want to save and invest that money. Another thing I would recommend doing is if you work for a publicly traded company, which is a company where the stock trades on the stock market with the major exchanges, ask your employer about an employee stock purchasing plan. I did this with my HR department at the company I worked for, and I'm glad I did because I found out that they actually offered employees a discount if they agreed to hold shares for a set period of time. So I was able to actually purchase shares of my employer at an immediate discount compared to what they sold for on the market, as long as I promised not to sell those shares for a set period of time. So for me, that was like a guaranteed ROI of as long as I put my money in, I can get it for a cheaper price than it's already for sale for on the market. As long as the company stock doesn't go down, which it's a utility stock, they don't really go anywhere, it was a way for me to immediately get some free money. So that's another thing I did is I directed a percentage of my paycheck towards company stock purchasing and just essentially did that automatically every single week from my paycheck. So you're going to want to talk to your HR department and ask about 401k match, as well as any type of employee stock purchasing program. And then the final step here for saving 50% of your income from 21 to 24 is be frugal AF. You guys know what AF means. I'm not going to say it out loud, but do that. Be as frugal as possible. And I know this may not sound fun. This may not sound cool. This is not a video called How to Have an Exciting Life in Your 20s. This is a video about how to set yourself up in your 20s to where in your 30s, 40s, and 50s, you probably don't have to worry about money that much because of how much you've already done. So be as frugal as possible and gamify your life. I know this sounds kind of weird, but I used to be really into video games when I was younger, and I started applying the same school of thought to my life and my finances, and I turned it into a game to see how little money I could live off of, how little I could spend, and how much I could possibly save and invest. And I encourage you to do the exact same thing yourself. Also, guys, one question people always ask me when talking about this is whether or not you should have a relationship during this period. And what I want to say about that is if your partner is on the same page with you financially and they're fine with you being frugal and cooking and bringing your lunch places, then absolutely, there's no reason to make yourself suffer and not to date in your 20s. However, if you have a certain goal in mind of what you're looking to attain, be it financially or whatever, and your partner is not on the same page, meaning that you want to stay in on Friday night and cook, that way you save money, and your partner is fighting with you because she wants to or he wants to go out for a date and to the movies or something, that is where you either have to budget entertainment funds or that may not be the right relationship for you. So I'm not saying to avoid relationships, but just make sure that your partner is on the same page with you about what you're looking to achieve. Alrighty guys, so now let's get into some of the fun stuff here, which is going to be actually looking at the numbers and how this all plays out. So, assuming you got a high ROI degree from a community college, I'm going to assume you'll be able to land a job with a $50,000 salary. And just to speak from my own personal experience, I got a 2-year associate's degree from a community college. I got a union job for a utility company where I was starting off at a salary of around $63,000 per year, fresh out of college, 20 years old. So, I am living proof that this is actually possible, and so by saying 50K, we're actually way undershooting based on what I was able to do. So trust me guys, I know you can do the exact same thing yourself and probably make even more than $50,000. So starting off here guys, if you make a $50,000 salary, of course, you have to pay your taxes to Uncle Sam. So after you pay taxes, your take home is going to be around $37,500. And I'm encouraging you to save half of that income, which is going to be savings of around $18,000 per year. And as I said, you're going to do that from age 21 to age 24, which means you should be able to save/invest around $54,000 over 3 years from 21 to 24 by saving half of your income. Now, in terms of what you actually do with that money, that's kind of up to you to decide. If you want, you can invest this money to allow it to grow, or you can set it aside in savings, or you may decide to go out there and do some stock picking if you want to invest yourself. I personally did a little bit of everything, which is what I recommend as well. However, let me just restate this, guys. I'm not a financial advisor. This is not any kind of personalized financial advice. This is simply what I did myself, and it's up to you to decide if you think this is a good idea for you yourself to follow this. But what I did is I got all of the free money first. And what I mean by that is I mean things like the 401k, where you got the free bonus in terms of your company match. I also did the employee stock purchasing, and I got that free bonus because I was buying shares at a discount. After I got all the free money, all of the rest of my savings here, whatever didn't go over here to the free money stuff, went into this pie right here, which breaks up basically into 3 even chunks. In one area, I was doing passive investing, so I'm going to say PI. This is just passively putting your money into index funds or something really boring where there's not a heck of a lot of risk. You're just slowly investing over time. I put about a third of that into my EF, which is my emergency fund, which is just a cash savings account where I have money in case of emergency. And in this third piece of the pie, this is where I did my stocks. So at that point in my life, I actually wanted to be a swing trader, and I was trying to be a swing trader. So I took a portion of all of my leftover money after I put it towards the 401k and the stock purchasing, and I took about a third of that leftover money and I put it into swing trading and basically trading stocks to try to make money. I was unsuccessful with that. I wasn't able to make much money at all, so eventually I got rid of that, and I didn't do swing trading. I just did like some individual stock long-term ownership. But if you do decide that you want to dabble with the stock market or anything like that, you can do this. I would just say make sure you're successfully making money, and if you find that this area right here ends up being a drain on your account, where like the values here are going up, or this wouldn't go up because it's just your emergency fund. But if your passive investments are doing really well and then your active investments are making you lose money, maybe it's time to just get rid of the active component and just be a passive investor. But essentially, from age 21 to 24, you should be able to save up and invest around $54,000, which is going to be important for the next step. All right, guys, so if you follow these steps from age 21 to age 24, and you followed all the other steps that we've outlined so far, this is the situation that you should be in as a 24-year-old adult. First of all, 750 plus credit score should be possible at this point based on 8 years of on-time payments. If you start building credit at 18 years old, guys, from 18 to 24, I'm sorry, that's actually 6 years. Let me fix that math there, guys, before you yell at me in the comments. 6 years of on-time payments there. You do also, from age 21 to 24, you stayed at that job, which gives you 3 years of work history. Not to mention, since you saved/invested around 50% of your income, you should have about a $50,000 net worth between your 401k, individual stocks, emergency fund, and potentially your passive investments. And you may even have $0 in debt if you were able to pay off your pre-owned vehicle in that 3-year period. You know what that means, guys? All of this right here paints a picture for somebody who is financially wise, which means the bank will let you borrow money. This is when it's time to put that $50K to work and start building up some real assets through real estate. I know this is where things get exciting, guys, and from 18 to 24, it might sound kind of boring, but this is very important stuff for setting yourself up for success in this 6-year period right here. So now let's get into the very next step. So now at age 24, the next step which I followed is getting into my first house hack. If you've been paying attention to, YouTube videos, you've probably heard of this concept before, and I still do this today at age 26, well, turning 26 shortly. I'm actually recording this from the bedroom of my house hack. And so essentially what I did is, rather than going out there and buying a single family home, which is a terrible investment, I actually purchased a 3-unit property, which allowed me to occupy one of the units myself while renting out the others. And you pretty much have 2 different options when you get started with your first house hack. Option number 1 is for a conventional 20% down loan, which is going to be tricky, especially when you don't have a lot of cash flow other than just the money from your job. You've got like one income stream, maybe a little bit of investment income, but you really haven't had much time to allow it to grow. So most of the money you have is just what you were able to save over the last 3 years. But again, because you're driving an old car, or one that isn't, brand new, where your payment is too high, and because you're living at home during this period from 21 to 24, you're paying a lesser amount of money towards rent to your parents or your guardian, and you're keeping those expenses as low as possible. So hopefully this has ultimately allowed you to save up around $50,000. Your second option, which is way more appealing in my opinion, is utilizing something called the FHA loan, which is just 3.5% down. And this is exactly what I did with my first house hack. So just for numbers' sake here, guys, let's say a decent house hack is going to cost you around $500,000. However, depending on where you live, it could be $1 million or as low as $200,000. In my real estate market, a nice 3-family property cost me around $500,000. But the important thing is, guys, I didn't need to have almost any of that money because of my responsible credit history and my work history and all of this stuff that works to my advantage. So if I was looking to purchase a $500,000 property with a conventional loan, I would have to put down around $125,000 between closing costs and my down payment. And clearly, if you only have 50 grand saved up, that's just not a logical goal or outcome because you probably don't have 125 grand. However, with that FHA loan at 3.5% down, that was a much lower amount of money. In fact, you could probably get away with about a $30,000 down payment. Mine was even lower. I actually put 22 grand down on this property. So for 22 grand, I locked in a $500,000 asset, which had 3 different units. The only downside is you are going to have to pay something called PMI, which is insurance that the mortgage company requires you to have to insure the bank, because you have almost zero equity in this property, which means if you walk away from it, the bank may not be able to sell this property for enough money to pay off that mortgage and get their money back. So as a result, you pay for PMI. That way the bank is insured in case they lose a bunch of money by you walking away from the property. There is a way to eliminate that PMI down the road, which I did, and we're going to cover that later. But essentially, the next step from 24 to 25 is looking for a nice 3 to 4 unit property for your very first house hack and utilizing that FHA loan if you need to based on your area. That way you don't have to put a boatload of money down on this property. So that's what I did, and that's what I definitely recommend. As far as the source of funds, you could use cash from your emergency fund. You could sell some stocks from your own portfolio or some of your company shares if you've been using an employee, stock purchasing program, or talk to a tax advisor and you may be able to use a portion or all of that 401k towards the purchase of your first home. So you should at this point have a lot of different options available to you in terms of figuring out how to come up with that down payment. But this is what's going to get you into the door of true financial abundance, is this very first step of getting into a house hack where you're essentially zeroing out your mortgage. And let me explain to you what I mean about that now. So your goal with this house hack is to essentially have a $0 mortgage. And what I mean by that is after you factor in your tax write-offs associated with owning real estate for rental purposes, as well as things such as the principal paydown of the mortgage, after factoring in those different things, you essentially want to have a $0 mortgage. So what I mean by that, guys, is you take your total mortgage per month, and then you subtract out any money going towards principal, and then you would subtract out any tax benefits, which you're probably not going to factor those in until the end of the year during tax season. You're going to subtract out the rents from your tenants, and ideally, that number should be around $0. That essentially means that you live for free, and every month you're building free equity in this property or ownership in this property. And so now, rather than paying rent to your mom or dad or your guardian, you're not paying rent to anyone, you live for free, and now we can begin to accelerate your rate of savings. So once you figure out your house hack, from age 25 to age 27, you have two goals in mind. Number one, if you're handy, fix up the place, because we're going to refinance it later. So if there's any improvements you can make, fixing up the place, remodeling it, any sweat equity you can build into this property, you damn well want to do that. In addition to that, because you now ideally have that $0 mortgage, which is very possible with a 3-unit house hack, now rather than paying rent to a guardian, you're able to accelerate your rate of monthly savings. So at this point here, guys, from age 25 to age 27, you want to have the goal of fixing up the place if possible and saving even more money. So over those 2 years, you should be able to continue saving 50% of your income. And again, we're assuming that you have not gotten a raise in this entire period, which is very likely, but we're still keeping the numbers low just to show you guys how easy this is to do. So saving half of your income means you're able to save another $18K per year. But in addition, by having no rent, because you now have a house hack, you're going to be able to save that money that you were originally paying in rent to your family member. I'm estimating this is around $6,000 per year in savings. So you went from being able to save $18,000 per year to now saving around $24,000 per year thanks to your house hack. Now, if you bought a property in a good area that's going up in value, especially if you've been making improvements to that property, at age 27, 2 years after you started this loan, you may want to consider something called a refinance, where you're essentially looking to refinance this as a conventional loan and eliminate that PMI. This totally depends on the market that you're in. I personally own real estate in a pretty good area where a lot of people are trying to move here, so the prices are going way up in value. So due to that, I was able to refinance and get a lot more equity. So let me walk you guys through that process now, because that's essentially the next step. By saving money from 25 to 27, at these savings rates, you should be able to save up about $75,000 of cash/investments in stocks and passive investments, and you should have around $15,000 of equity in that house just from principal paydown of that mortgage. At this point, you may want to pursue refinancing that property. So let's say, for example, that house that you purchased for $500,000 over 2 years based on some improvements that you made is now worth 10% more, or $550K. Well, this is where things start to get interesting, because over that 2-year period, you actually were paying down that mortgage every single month. However, if you did it right, your tenants are actually paying that mortgage for you because you live for free, which is the clear benefit of house hacking. So during that 2-year period, you actually build up about $30,000 of equity in that property, which, based on, combining your down payment plus your principal pay down, means that your current loan on that property is only around $470,000. So what this actually means here is that you have $30,000 of equity in this property just based on the current, the value, the appraised value back when you bought it. But the interesting thing is, your property is actually now worth around $550,000 from a formal appraisal from a bank. So what that means is that you owe $470,000 on this property, but it's actually worth $550,000, meaning you actually have $80,000 in equity based on the fact that that property has gone up in value while you owned it. So this might get a little bit confusing here, guys, and if it does, just follow along for now and eventually just talk to a mortgage broker about a refinance, and they're going to explain the whole process to you guys. Don't worry. But essentially, between the pay down of that mortgage right here and it increasing in value, you should have about $80,000 of equity in that property, which you will now be able to use to put towards that loan. Because the loan for the property is only $500,000, but the bank is now telling you it's worth $550,000. That is where the refi comes in. You're going to basically take that additional equity, get a new loan for $550,000, and get to something called 20% loan to value. Essentially what that means is you have enough equity in the property that PMI is no longer in the equation. And I don't know if you guys understand how much this can be, but like on my house hack, this PMI was around $325 per month. So if you're able to eliminate this, you can significantly lower your mortgage and save more money every single month. Alrighty guys, so now let's go ahead and cover the specific numbers here for this loan refinance. And if you're not familiar with what a refinance is, guys, that pretty much means you get rid of the old loan on that thing and get a new one, hopefully at more attractive rates. I did this myself with my first house hack for 2 reasons. Actually 3 reasons. Number 1, I made some updates to the property which made it more valuable. Number 2, interest rates had fallen quite a bit. And of course, number 3, I wanted to eliminate that PMI and I had some extra cash to put into the deal. Essentially, what you're going to do here is combine your extra money from saving up over the last couple of years plus your principal pay down, which means you own more of that property, plus it has hopefully gone up in value if you live in a good area, in a good real estate market, especially if you've made improvements to the property. So originally your loan was for $500,000, 3.5% down. You've paid it off for a couple of years, so you have some equity in the property. But now you want to get a new loan on this property for $550,000 at 20% down. That means you're going to have to put down about $110K plus around $10K in other closing costs. The unfortunate thing is most of this money right here, the other $10,000 in closing costs, is pretty much throwaway money. It goes towards mortgage, tax, and different things like that. A lot of this you're just never going to see. But this $110 right here essentially goes back in your pocket. It's just locked up in your house because you're holding that value within the house itself. So anyways, guys, you've got to come up with $120,000 in order to refinance this loan, and let's talk about how you would do that. Well, first of all, you have some equity in your property because the bank has said, we believe this is worth $550,000, and you had an original loan for $500K that you've been paying off for 2 years, so now you only owe $470,000 left on this mortgage, which means you have $80,000 of equity which you can use towards this new loan. The bank says the house is worth $550K. You only owe $470,000. This is your money to put towards that new loan. Now you just have to come up with the difference between these two, which is $40,000 in cash which is essentially just going to come out of your investments or your savings from the last 2 years. The good news is that since you're living rent-free now because of this house hack, you're able to accelerate your rate of savings. So coming up with another $40,000 over a 2-year period with house hacking, with this minimalistic lifestyle where you spend as little as possible, this should really be no problem at all. At this point, you have refinanced, drastically lowered your mortgage, and eliminated that pesky PMI. So this alone should probably mean you're able to save even more money based on not paying PMI, having more equity in the property, and having a lower mortgage payment. So let's talk about that rate of savings now. So first of all, you still have $18,000 per year, which comes from saving 50% of your income, which we've been doing since the beginning of this whole plan. Second of all, because you're living rent-free in your house hack, that's an additional $6,000 per year that you can save. Originally, you were giving that to mom and dad or your guardian, but now you live for free and your tenants pay the rent, your tenants pay the mortgage, so you live there for free when you factor in the principal pay down and different things like that. But now you've refinanced, you've eliminated that PMI, and you have more equity in this property, so your mortgage is actually going to be lower, which means your property should now be cash flow positive, which means rather than living for free, you're actually getting paid to live there. And I know this sounds like a crazy scenario, but I'm living proof that it's possible because I get paid every single month to live in my house hack because of exactly what I've done here. So I'm estimating that based on these numbers here, with the principal pay down, getting rid of PMI, that should mean you're able to earn about an additional $4,000 per year in additional cash flow from not having PMI and potentially having a cash flow positive property, which means you're now able to save up $28,000 per year, drastically accelerating your rate at which you are able to save. So now at this point, after putting some of your cash into the deal, you should have about $35,000 left over based on your previous rate of savings, and you should be able to save about $28,000 per year. So you got 35 grand-ish in the bank and you're saving about $28K per year. And this is what you're going to do from age 27 to age 30. So after you complete that refinance, by age 27, assuming you followed these steps, this is what your personal net worth should look like. First of all, you have $110,000 of equity in that new loan because you refinance. That is your money. As long as the value of your property doesn't go down, in fact, it should continue to go up over time, this is going to climb higher and higher. Not to mention, you're also paying that mortgage down over time, which means that you're going to have more and more money here as you own that property. The longer you own it, the more it's going to pay you as long as it's a good area and prices continue going up. You should have about $35,000 left over of liquid emergency fund savings as well as the stonks. We all love those. You're going to have some of those there too, be it passive or active investments. And keep in mind, hopefully you've been contributing to that 401k now for a period of 7 years or so, depending on when you got your job. We figured you got it at, age 21. So 6 or 7 years now, you've been slowly contributing to that 401k. So between the contributions, as well as it going up in value and earning dividends, you should have around $50,000 in your 401k. So now, based on these three things, the equity in your first house hack, your liquid investments and your stonks, as well as your 401k, you should now have a net worth of around $185,000 at age 27. But keep in mind, guys, this is showing you my plan that I was going to follow to have a $350,000 net worth by age 30. So we have just about, 3 short years here to make our next big move financially and significantly accelerate our net worth. So let's talk about what that looks like now. So now, as I'm sure you guessed here, guys, the next goal is to save up more money for another rental property. That is the number one option that most people have available to them to build wealth in the United States. You can continue doing some stock market stuff, you can continue doing other stuff, but real estate is your ticket here, guys, because it allows you to leverage up on an asset in a safe manner. You don't have to know what that means for the scope of this video, guys, but if you're looking to learn more about that, that is something that you may want to explore. So that being said, you want to have the goal now of saving up about $120,000 for your next rental property, where you're essentially going to do the same thing all over again, another 20% down conventional loan on another property. So from age 27 to 30, as we said, you're aiming to save at a rate of around $28,000 per year based on what we talked about earlier. We also know that you should have around $35,000 left over of just liquid assets from your emergency fund after you refinance at 27 years old. And so essentially you're just going to leave that money there, and from 27 to 30, just add that to the pile. Maybe, following that pie that we talked about earlier, where some of that goes to emergency funds, some of it goes to passive, and some of it goes to active. That way, your money's not just sitting there, not growing whatsoever. Your goal here is to save up $120,000 for the purchase of your next rental property. You should be able to accomplish this by 30 based on this rate of savings right here. However, if you're getting a raise from your job or you're doing really well in the stock market or something, there's a potential to do this even sooner. The goal is to get about 120 grand for your next purchase of another property. So then once you have another $120,000 saved up over about a 3-year period, it's time for another real estate purchase here, and you're going to buy another 3 to 4 unit property. However, the difference is, rather than residing in one of these units, you're going to rent the entire place out and you're going to make a lot more money. So once again, let's go through these numbers right here. With this new property, you're going to be doing conventional 20% down. Let's assume it's going to be $500,000, which means you're going to have about $100K down. And then you're going to have about $10K in closing costs. As we said, that's kind of, throwaway money. You're not going to see much of that going back into your pocket. A lot of it is just taxes and fees associated with a refinance. Then you're going to have this new property that's bringing in additional monthly cash flow. So at this point, let's go ahead and talk about what your net worth would be. Now, you're 30 years old. Let's talk about what your net worth is likely going to be. You have your original house hack that's still getting paid down. You're living in one of those units for free, actually getting paid to live there. You also have your 401k, maybe some savings and some stock investments as well. And you just bought another 3 to 4 unit rental property, 20% down, no PMI. That's massively cash flow positive because you're not paying PMI and you're not living there. So all of those units can be rented out. At this point, guys, all you would do is rinse and repeat this strategy. That's how people truly become rich, buying more houses. This is how people end up owning thousands of different units. You just start with one and then you keep going. But even if you just have 2 guys, let's talk about now what your net worth would be as this 30-year-old individual. Alrighty, guys, so here we are now. You're 30 years old. Let's talk about what your net worth is, what your savings rate is, and what the rest of your life looks like at this point. Because I mean it when I say it, guys. This plan that I was going to follow literally sets you up for success for the rest of your life, okay? As long as you're not an idiot, and if you already followed this plan for 12 years, I know you're not an idiot, otherwise you wouldn't be able to do this. So this is just something I'm so passionate about, guys. I really do. I want you to follow a plan like this yourself that you come up with that allows you to not have to worry about money. And so if you have found any value in this video so far, guys, there's probably about 10 hours of research in this. All that I ask is that you drop a like and subscribe. And maybe leave me a comment and let me know what you think of this so far. That being said, guys, let's get into the final reveal here of these numbers, all right? So you're 30 years old. Let's calculate your net worth first. Well, first of all, that brand new rental property that you just purchased, you now have about $100,000 of equity in that property right after your closing. The closing costs, those kind of go away, so you got 100 grand of equity. Your house hack, on the other hand, over that period where you're saving up money for your new rental property here, you were still having that mortgage paid down by your tenants. So now you would have $150,000 of equity in that property, since every single month that mortgage is getting lower and lower, and not even mentioning that this is still going up in value. In the 401k, we're assuming you'd have around $80,000 based on continued contributions and dividends and asset appreciation. You also have some liquid savings of around $20,000. And guys, these numbers are not just coming out of my butt. This is based on the annual savings rate based on what we're going to cover over here shortly. So all these numbers work out. If you want to test my math on it, go ahead, guys. I literally spent hours writing this plan out on the plane myself. So I know all these numbers check out. Anyway, when we add all this together, guys, this gives you a net worth of around $350,000 at age 30, which is just so incredible to have done that at age 30 when most people are just starting to think about things like 401k, buying a house. You're already worth more than $250,000. That's just so exciting to me. That being said, guys, this is your net worth at 30. If you know this is the plan I was going to follow, let's now talk about how much money this enables you to save every single year. Well, you're still saving 50% of the income from your job, assuming again that you have not had a raise in 9 years, which is very unlikely, but we're going to just do those numbers just to be conservative. That means you're able to save that $18,000 per year. Your original house hack, just from not paying rent alone, means you're able to save around $6,000 per year since you just live for free. After the refi and getting rid of PMI, that property should now be cash flow positive, which should result in an additional $4,000 per year of cash flow. After factoring principal paydown, that should be the amount of money you're getting from not paying PMI, the difference between that refinance, lowering that mortgage. The second property, on the other hand, is totally cash flow positive because you rent out all of those units. And conservatively, guys, I'm saying that's going to bring in around $12,000 per year of rental income, which is just $1,000 per month. It probably in reality would be significantly higher. You add all this together here, guys, and this means that the amount of money you'd make per year is $40,000. Or I'm sorry, that's the amount you're saving every single year, not just making. But what's cool about this, guys, is now the majority of this money is coming from things that you're not working for, because only $18,000 is coming from your job. The other $22,000 is coming from your assets. Not to mention, guys, at this point in your life, you would now own at least $1 million worth of real estate between the two properties. And even though they're not fully paid off, you own those properties. And if they go up in value, that's money in your pocket. We know that real estate tends to go up at around 5% per year as a conservative estimate. So just from that property, just from those two properties going up in value, you should have an additional $50,000 per year of just asset appreciation from those properties. And if you want to access this money, all you have to do is refinance that property. So there you have it, guys. That is the step-by-step plan that I was going to follow to go from $0 as an 18-year-old to being worth over $250,000 by age 30. And if I had followed this plan, I would have been a 30-year-old living for free, actually making money to live in my house with a cash flow positive property that I owned around the corner. And I'd be making about, even beyond my salary, with that all factored in, I would be saving about $40,000 per year and making around $50,000 per year doing nothing just by owning these properties. That's how you set yourself up for success financially, guys. That is the plan I was going to follow. But YouTube largely accelerated this by increasing my earnings significantly, so I basically just did everything that you saw here much sooner. So anyways, guys, there you have it. I hope you enjoyed this video. If you made it to the very end, make sure you drop a comment down below and just say something funny about my shirt or something. I always love to see how many people stick around for these marathon videos. I hope this provided you with a tremendous amount of value here, guys. And again, not here to sell you anything. If you want to use some of my affiliate links in my other videos, you're more than welcome to, but I just want to show you guys the plan that I came up with here when I was younger. I followed it for about 5 years, then I kind of deviated with the YouTube channel, but this right here was my exact financial plan when I was just 18 years old. So I appreciate you guys for watching. If you haven't already, subscribe and hit that bell for notifications, and I will see you in the next video.